For a long time, Arizona represented the classic American dream. It offered wide stretches of open land, fast-growing cities, and homes that felt like a peaceful alternative to the nonstop frenzy of California. But heading into 2026, that vision is starting to fall apart. Across the state, from the endless suburbs surrounding Phoenix to the scenic mountain hideaways near Flagstaff, the housing market is running into a harsh reality. Rising mortgage rates, affordability that's fallen off a cliff, unexpected insurance costs, and too many newly built homes with too few buyers are all colliding at once. What used to be one of the hottest real estate markets in the country has cooled dramatically. Builders are putting projects on pause. Homeowners are cutting prices in hopes of attracting interest. Investors who once rushed into the desert are now slipping away quietly. This is Discover the Cities, and today we're counting down the 10 Arizona cities where home prices are expected to crash in 2026. Stick around until number 1, because the city at the center of this downturn might not be the one you're expecting. Number 10. Prescott. For years, Prescott branded itself as Arizona's ideal retirement destination. Nestled among pine-covered hills with cool mountain breezes and a charming historic downtown, it attracted retirees looking to trade Phoenix's heat and congestion for something calmer and more picturesque. It felt like a postcard version of peaceful living. But as 2026 approaches, that image is starting to fade fast. From 2020 through 2023, home values in Prescott surged at an eye-popping pace. Median prices jumped close to 70%, eventually cresting above $650,000. That climb didn't last. By late 2025, prices had already slid back to roughly $530,000, and analysts say the correction isn't finished yet. Current forecasts suggest another 10 to 15% drop before the end of 2026. So what went wrong? Simply put, the buyers disappeared. Higher property insurance premiums, rising HOA fees, and escalating maintenance costs have become overwhelming, especially for retirees living on fixed incomes. Homes that once represented comfort and security are now straining monthly budgets. As a result, many longtime residents are selling under pressure, sometimes walking away with less than what they originally paid. At the same time, aggressive construction has backfired. Developments in Chino Valley and Prescott Valley that were once pitched as retirement-ready neighborhoods now sit partially vacant. Rows of sun-bleached for sale signs tell the story of a boom that cooled too quickly. Local real estate agents say open houses that once drew crowds of out-of-state shoppers now echo with silence. Cash buyers, who once propped up the market, are either demanding discounts of 25% or more, or skipping the deal entirely. Prescott's struggle goes beyond economics. It's a generational shift. The migration that transformed the city into a retirement hotspot is now reversing course. Seniors are being pushed out by rising costs and insurance headaches, while younger families are priced out and unable to step in. The town that once promised tranquility and stability is now on uncertain footing. If current trends hold, Prescott may soon force people to rethink what retiring in Arizona really looks like. Number 9. Gilbert. Gilbert was once the shining example of Arizona's suburban success story, a place many believed was untouchable. For decades, this Phoenix area suburb symbolized stability and growth, with brand new schools, carefully planned neighborhoods, and a housing market that seemed to shrug off every slowdown. But heading into 2026, even Gilbert's clean streets and well-kept lawns can't conceal the growing stress beneath the surface. During the pandemic years, home values here skyrocketed. Between 2020 and 2022, prices surged by nearly 70% as families streamed in, many from California, lured by warm weather and the promise of upscale living at a lower cost. That promise, however, has quickly unraveled. The median home price has dropped from about $640,000 to just under $520,000, marking a sharp 19% decline in barely a year. Homes that once ignited bidding wars in 2021 are now sitting unsold for months. Sellers are chopping $80,000 or more off asking prices just to spark interest. This isn't simple buyer burnout. It's a reflection of deeper financial strain. Gilbert's economy relies heavily on construction, education, and healthcare, industries that are now tightening their belts and cutting back. At the same time, inflation has steadily eroded take-home pay, while property taxes and insurance premiums have climbed at alarming rates. The math has become impossible for many residents. A home that used to cost around $2,400 a month to carry now runs closer to $4,000 once higher mortgage rates and insurance hikes are factored in. Even households earning six figures are starting to fall behind. For a city built around middle-class aspiration, those numbers no longer add up. Developers are responding by pulling back. Building permits have dropped by roughly 35%, and some subdivisions have stalled halfway through construction. Investors are also feeling the pressure. Short-term rental owners are watching occupancy fall below 55%, wiping out profits almost overnight. Gilbert isn't imploding all at once, but beneath the manicured lawns and quiet cul-de-sacs, a slow and steady correction is clearly underway. Number 8. Flagstaff. Perched high above the desert and surrounded by towering ponderosa pines, Flagstaff was long viewed as untouchable when it came to housing downturns. With a steady mix of university jobs, tourism dollars, and affluent second home buyers, this mountain town felt insulated from the boom and bust cycles that hit the rest of Arizona. But now, even this alpine retreat is feeling the cold grip of a market pullback. After prices surged past $800,000 in 2022, Flagstaff's housing market began to retreat. Median home values are already down about 17%, and local real estate professionals caution that the slide may continue well into 2026. What's driving the downturn is a familiar issue. Affordability has completely unraveled. Income growth simply hasn't kept up with rising costs. Even households with two strong salaries and six-figure earnings are struggling to qualify for loans with mortgage rates hovering near 7%. A relatively modest $600,000 home now carries a monthly cost exceeding $5,000, and that's before factoring in insurance or property taxes. The numbers no longer make sense for most local buyers. Flagstaff's former advantage as a Zoom town has also faded. As companies call remote workers back to offices in Phoenix, Los Angeles, and Silicon Valley, the influx of high-earning newcomers has reversed. Vacation rentals now sit empty, and short-term listings have begun to outnumber traditional long-term options. Those short-term rental owners, once central to Flagstaff's growth, are now among the most nervous sellers in the market. Tighter regulations, slowing tourism, and rising utility expenses have flipped once profitable properties into money losers. Many owners are rushing to list their homes, flooding the market with overpriced listings that fail to attract buyers. Developers, too, are retreating. Plans for luxury mountain lodges and condo developments are being quietly put on hold as lenders grow increasingly cautious. For decades, Flagstaff stood as a symbol of exclusivity, a high-altitude refuge above Arizona's volatility. But in 2026, even a city in the clouds can't escape economic gravity. The downturn has reached the mountaintop, and the quiet that follows may linger far longer than expected. Number 7. Tucson. Tucson was long considered Arizona's best-kept secret, a more affordable, laid-back alternative to Phoenix, rich in desert beauty, culture, and that unmistakable college town vibe. For years, it sold the idea of balance, access to big city conveniences without the crushing price tag. But that promise is now coming undone. During the pandemic, Tucson's housing market took off at a stunning pace. In just 2 years, home prices jumped roughly 55%. That surge didn't last. Since 2024, median home values have dropped close to 15%, while the number of active listings has doubled, signaling a market that's losing its footing fast. The less obvious force behind Tucson's decline is insurance. Repeated flash flooding, destructive monsoon seasons, and growing wildfire threats have driven premiums sharply higher across Pima County. In many neighborhoods, annual insurance costs now exceed $6,000, erasing affordability even for residents who have lived there for years. A $400,000 home that once cost about $2,400 a month to carry now demands nearly $3,800 after insurance, property taxes, and HOA fees are added in. That's an unsustainable burden in a city where the median household income sits around $63,000. Many families who stretched their finances to buy during the boom are now falling behind. Renters aren't spared either, as landlords raise rents in an attempt to offset rising expenses. Short-term rental owners, once a major part of Tucson's pandemic-era success, are also feeling the pain. Occupancy rates have slipped below 50%, forcing investors to sell at steep losses. The warning signs are already visible. Foreclosures are up about 30% compared to last year, and half-finished subdivisions are quietly grinding to a halt as developers abandon projects midstream. Tucson was meant to be the place where affordability and opportunity met. Instead, by 2026, it's becoming a clear example of Arizona's housing paradox. A city where incomes stagnate, living costs soar, and the desert dream slowly gives way to financial exhaustion. Number 6. Mesa. Mesa, the massive anchor of Phoenix's East Valley, was once the picture of suburban achievement. It had a reputation for being safe, family-oriented, and expanding at a pace few cities in the country could match. Growth was its identity. But by 2026, that very expansion is proving to be its greatest weakness. Since peaking in 2022, home prices in Mesa have dropped close to 20%, and there's little sign the decline is easing. During the pandemic surge, builders rushed in, filling the city with new developments under the assumption that population growth would never slow. That gamble hasn't paid off. Buyers failed to materialize, leaving neighborhoods in Eastmark, Gateway, and Power Ranch dotted with half-completed homes and price reductions that deepen month after month. Longtime homeowners aren't escaping the fallout either. Annual insurance premiums that once hovered around $1,800 have ballooned past $5,000 for many properties. When you layer in mortgage rates near 7%, rising HOA fees, and higher property taxes, the cost of owning a home has effectively doubled in just 4 years. For many families, the financial pressure has become overwhelming. Real estate agents describe Mesa's market as paralyzed by fear. Listings sit untouched for months, and sellers are stuck cutting prices again and again, chasing a bottom that keeps slipping away. Investors, who once eagerly bought up rental homes, have largely disappeared, spooked by shrinking returns and declining rents. According to local economists, Mesa's greatest vulnerability isn't just financial, it's psychological. The city was built on the assumption that real estate values only move in one direction, that steady appreciation was guaranteed. Now, as home equity evaporates and confidence turns into anxiety, even a market once seen as rock solid is starting to fracture. Analysts are forecasting an additional 10 to 15% drop by the end of 2026, erasing billions in home value and forcing a fundamental rethink of the city's trajectory. Mesa's downturn isn't merely a routine adjustment, it's a wake-up call. If the heart of Arizona's suburban core can falter, it raises a troubling question. What part of the state is truly safe? Number 5. Sedona. Sedona, with its iconic red rock landscapes, was once seen as a refuge for artists, retirees, and anyone chasing a quieter, more spiritual version of desert life. It offered beauty, calm, and the sense that you were buying into something timeless. But as 2026 approaches, that sense of peace has given way to growing financial pressure. Long believed to be insulated from the ups and downs affecting Arizona's larger metro areas, Sedona is now caught in the same painful market correction. Home values that climbed past $950,000 in 2022 have fallen by nearly 20% in just 2 years. High-end properties that once sold almost instantly are now sitting unsold for months, even after price reductions well into the 6 figures. The reasons run deep. Rapidly rising insurance costs, softer tourism demand, and tighter rules on short-term rentals have collided, draining the market of momentum. Airbnb occupancy has dropped below 50%, and many investors who expected steady, year-round bookings are now falling behind on payments. Entire streets of luxury vacation homes sit dark, stunning to look at, but empty and unproductive. Local residents are feeling the squeeze as well. Property taxes have risen sharply despite declining home values, while everyday expenses, from groceries to utility bills, continue to climb. For many longtime homeowners on fixed incomes, the combination of maintenance, insurance, and taxes has become unmanageable, forcing difficult decisions to sell. Sedona's economy, once buoyed by art galleries, spas, and boutique tourism, is starting to lose its footing. Developers who previously marketed the city as the Aspen of the desert are quietly shelving new projects as risk grows harder to ignore. Real estate agents describe the current market as a contradiction, extraordinary natural beauty paired with increasing economic fragility. Sellers are still anchored to yesterday's prices, but buyers have retreated, choosing caution over emotion. In 2026, beneath those towering crimson cliffs, the fractures in Arizona's housing dream are spreading. Slowly, silently, and in ways that can no longer be dismissed. Number 4. Scottsdale. For decades, Scottsdale was more than just another Arizona city. It was a lifestyle statement. With world-class golf resorts, sprawling million-dollar estates, and exotic cars gliding down palm-lined boulevards, it earned a reputation as the Beverly Hills of the desert. Endless sunshine paired with exclusivity turned Scottsdale into one of the most coveted zip codes in the country. But by 2026, even this symbol of wealth and status is starting to feel the strain. Home values in Scottsdale have dropped roughly 18% in just 1 year. Yet the real problem isn't the sale price. It's the soaring cost of owning these properties. Luxury insurance policies that once cost around $6,000 a year are now pushing past $15,000. Homeowners associations are levying special assessments in the tens of thousands to cover storm damage and infrastructure repairs, while property taxes have climbed nearly 30% since 2020. Even buyers with cash in hand are pulling back. Real estate agents report that upscale listings now sit on the market for more than 200 days, forcing sellers to cut prices by hundreds of thousands of dollars. In exclusive enclaves like DC Ranch and Silverleaf, mansions that once carried seven-figure price tags are quietly being relisted below $800,000 and still struggling to attract interest. The investors who once treated Scottsdale as a luxury playground have vanished. Corporate buyers and out-of-state speculators have exited the market, leaving behind over-leveraged homes and increasingly nervous owners. What once felt like limitless demand has disappeared almost overnight. Scottsdale's downturn isn't just financial, it's emotional. The city's identity was built on confidence, prestige, and the belief that wealth could always stay ahead of risk. Now, as insurance premiums and tax bills eat into margins, that belief is cracking. In 2026, Scottsdale is confronting a reality few imagined. That even at the very top of the market, luxury isn't immune to a crash. Number 3. Chandler. Chandler was once Arizona's tech crown jewel, often called the Silicon Desert. With massive semiconductor facilities, rising salaries, and sleek master-planned neighborhoods, it projected an image of cutting-edge prosperity. For a while, everything about the city suggested unstoppable momentum. But by 2026, that image is beginning to fracture. After years of rapid growth driven by remote work and corporate expansion, the market has taken a sharp turn. Major tech companies have paused hiring, scaled back local operations, or shifted jobs overseas. Construction activity has slowed, and the impact is rippling outward, affecting every corner of Chandler's housing market. Median home prices are already down about 16%. High-end properties in neighborhoods like Ocotillo and Fulton Ranch are sitting unsold, sometimes for months at a time. Builders are responding with aggressive cuts, knocking $100,000 or more off asking prices just to generate interest. Even then, buyers remain hesitant, squeezed by mortgage rates near 7% and rapidly rising insurance costs. At the same time, the overall cost of living has surged. Energy bills have climbed, taxes are higher, and even well-paid engineers are tightening their budgets. Monthly payments that once felt manageable now feel overwhelming, turning what was supposed to be a smart investment into a financial strain. Local developers admit that Chandler's ambitious smart city expansion may have gone too far. The city is now dealing with excess supply and a shrinking pool of qualified buyers. Investors are either renting homes at a loss or walking away from projects entirely. Analysts see Chandler's downturn as a cautionary tale for fast-growing tech hubs across the country. When high-paying jobs slow and interest rates remain elevated, innovation alone can't prop up a housing market. In 2026, Chandler's slide may mark the first major correction of the Silicon Desert era. A clear reminder that prosperity built on momentum can disappear just as quickly as it arrived. Number 2. Phoenix. Phoenix, the engine behind Arizona's explosive rise, has now become the center of its long-awaited reckoning. Between 2019 and 2022, the city felt unstoppable. Home prices doubled in a matter of years. Bidding wars became routine, and buyers from out of state snapped up listings as if every property were a sure thing. The momentum was intense, but it burned too hot, too fast. Now, that heat is gone. Median home prices in Phoenix have already fallen about 15%. Housing inventory has doubled, and the frantic bidding wars that once defined the market have vanished. Builders who once struggled to keep up with demand are now sitting on thousands of unsold homes in suburbs like Goodyear, Surprise, and Peoria, waiting for buyers who no longer show up. At the peak of the boom, Phoenix was welcoming more new residents than any other metro area in the country. That wave has stalled. High interest rates, sharply rising insurance premiums, and ever-increasing property taxes have frozen demand in place. A city that thrived on constant migration is now confronting an uncomfortable reality. Growth has slowed to a crawl. The cost of ownership tells the story clearly. A typical home that cost around $1,700 a month to carry in 2020 now runs $2,900 or more, and that's before factoring in maintenance costs or HOA fees. Insurance rates have tripled in many areas, pushing affordability further out of reach. Even the rental market is weakening, with vacancy rates climbing to their highest levels since 2012. House flippers who once made easy money are exiting the market. Investors are unloading rental properties at losses, and some recent buyers are walking away as their equity evaporates. Foreclosure filings are already up about 20%, and analysts warn that what looks like a slow leak today could turn into a surge tomorrow. Phoenix's downturn isn't shaping up as a sudden collapse. It's a drawn-out grind. Month after month, prices slip lower, confidence erodes, and optimism is replaced by exhaustion. By the end of 2026, much of the wealth created during the pandemic boom may be gone. And Phoenix, once the poster child for Arizona's rise, could stand as the clearest symbol of its reversal. Number 1. Buckeye. At the top of the list sits Buckeye. Arizona's fastest-rising boomtown turned its most sobering warning. Not long ago, Buckeye was celebrated as the future of American suburbia. Developers painted a bold vision of high-tech master-planned communities, attainable homeownership, and limitless growth stretching into the desert. From 2019 to 2022, prices skyrocketed, more than doubling and surpassing every other city in Arizona. But growth that extreme always comes with a breaking point. By 2026, Buckeye has hit it hard. Home values are already down roughly 25%. Inventory has exploded to 4 times its previous levels, and construction zones that once hummed with activity now sit eerily quiet. Builders are pulling out every incentive imaginable. $50,000 price cuts, covered closing costs, free upgrades, yet buyers still aren't biting. The root problem is simple but devastating. Too much supply built on too much confidence. Developers raced ahead of actual population growth, assuming the flow of new residents from Phoenix and California would never slow. It did. And when it did, the consequences were immediate and severe. Worsening the situation are water constraints and stalled infrastructure. Neighborhoods advertised with parks, schools, and retail centers remain unfinished or delayed indefinitely. Buyers feel deceived, and many are walking away altogether. In partially built subdivisions, property values have dropped as much as 30%, trapping homeowners in developments that never fully materialized. Entire communities now sit half-complete, model homes surrounded by empty lots, dust, and weeds instead of neighbors. Investors who purchased pre-construction units are abandoning deposits rather than risk further losses. Even the rental market has weakened, as workers and families choose to move closer to Phoenix's core instead of farther out. Buckeye's collapse isn't a temporary dip, it's structural. It exposes what happens when optimism turns into denial and speculation outruns long-term sustainability. In 2026, Buckeye isn't just Arizona's clearest housing warning sign. It may be a national one, a stark example of how quickly the line between boom and bust can disappear in today's housing market. From Prescott's fading retirement promise to Buckeye's overbuilt suburbs, Arizona's housing surge has reached its breaking point. This isn't a mild correction, it's a full-scale reset, Rising insurance costs, water limitations, higher interest rates, and exhausted buyers have transformed the desert dream into a desert reckoning. Still, every downturn carries opportunity. For some, this reset will be a painful lesson. For others, it's a chance to rebuild with smarter planning and sustainable growth. You've been watching Discover the Cities. If you want more cinematic deep dives into America's changing cities, subscribe now, because the housing storm is only beginning.